The October Steamroller. Market sentiment is showing signs of fatigue even after a super strong bull market at the beginning of the month. Safe haven assets are receiving renewed interest. And yet, the spotlight turns to key upcoming events, notably the delayed U.S. inflation CPI release this Friday, and major U.S. stock indices wrapped up the week with modest gains despite all of these worries. Stay with us, folks. The CB3 Financial Weekly Podcast begins now. Last week brought another flurry of headlines for Wall Street, but underneath the noise, many core market themes remain the same: resilience mixed with caution. The major U.S. indices finished the week in the green. The S&P 500, Dow, and Nasdaq all posted modest gains, while the broader market rose about 1.7% for the week. So even amid the worries over the U.S. federal government shutdown and bank credit concerns, especially those small cap banks, markets held up fairly well. With the U.S. federal government shutdown as of October 1st, a number of critical economic data releases were either delayed or canceled, and that stays in effect this week, except for this Friday for CPI. And this has forced investors to lean on private sector surveys and second-tier indicators. The regional bank credit jitters definitely caught the market by surprise at the end of last week. So even though large banks still look sound, some regional and niche banks disclosed loan loss exposure tied to speculative credit. That triggered a noticeable bump in the volatility index, aka the VIX, and it added a layer of risk to investor sentiment. With some of the headline risk rising, shutdowns, trade tensions, credit concerns, etc., there were renewed interest in more defensive sectors and assets. Treasury yields slipped, volatility rose, and the idea of hedging came back into focus, and that is where our hedging program in all three CG, DS, and GI are helping our investors. The hedging to the downside in this very volatile month of October. So the tariff and trade shadow lines are what's confusing this, because the broader market drivers like the U.S.-China trade tension also reemerged. For instance, stocks struggled early in the week amid fresh concerns and then picked up once there were signs of easing. This back and forth between Trump and Xi Jinping is getting old for everybody, but that's the reality that we're dealing with while we wait to see if Putin is going to back down at all with the Ukraine-Russia war situation. So the sector rotation signals are starting to appear. There are some investors, some traders, some big hedge fund managers that are rotating out of the pricier assets that have had such a huge run-up since April and rotating into safer sectors. We are looking at that very thing and making trades tomorrow, actually, in our GI program to be a little more conservative there when it looks like the market could become more volatile, true to form for the month of October. So overall, it looks good to stay the course, and that's why we're doing it. We're 100% invested with our put hedge strategies in place. The market didn't surge ahead, but it didn't crack either. That suggests to me that investors are cautiously positioned, appreciative of the rally, but mindful of latent risks. So what's next as we move into the week and a month known for higher volatility? We're now halfway through October. Here are the key things to keep your ears to the ground on. With the government shutdowns having disrupted the regular release schedule, the upcoming U.S. Consumer Price Index CPI report is likely to carry an outsized weight in setting expectation around the Federal Reserve's next move. That report happens this Friday. Earnings from major technology and growth companies are slated to land, and given how stretched valuations are at this time, good or bad surprises could really trigger sharp reactions, but in either direction. All right. Historically, October has been tricky for stocks. Some call it the Mark Twain effect, with surprises, corrections, and trend reversals more common. With the setup of daily delays and credit uncertainty and trade scrutiny, the risk premium is elevated, and that makes for more volatility. Given this environment, keep an eye on how the sectors behave. I'll be doing it on your behalf, and whether investors lean into defensives like healthcare and staples or continue pursuing growth AI, and tech. The relative strength will tell us whether this is going to be a risk-off or risk-on finish to the month of October. A lot of information to digest. We'll be doing it for you, but I would keep an eye out on it just so you don't get surprised when you look in your account and see your returns for the day. Those of you that do that, all right? So the likelihood of sharp moves is always exacerbated in October. To sum it up, last week delivered modest gains in equities despite a fraught backdrop. The clear takeaway is resilience, but not complacency. We're entering this season, the last couple weeks of October, where the risk is higher than normal. But once we get to November, November is historically the best performing month of the year. Stay with us. We'll be back this Thursday night for CB3 Live. It's been delayed for a couple weeks. I'll explain that on the show. We will see you this Thursday night on CB3 Live.